ஜாயின் நோ கொடுத்துருக்கேன். ஜாயின் பண்ணிட்டேன்னா
Good afternoon, sir.
Good afternoon.
Sir, the screen share out one time. Yes, sir.
Sir, good afternoon, sir.
Good afternoon, sir.
Okay, sir.
Screen share தெரியுதாமா?
Yes, sir. Yes, sir.
Everything is clear, sir.
Okay.
Yes, sir. 2:30 க்கு ஸ்டார்ட் பண்ணிக்கலாம் sir.
ரைட் மேம். நான் இப்ப டிஸ்கனெக்ட் பண்ணவா இல்ல அப்படியே கனெக்டடா இருக்கட்டும்?
இப்படியே இருக்கட்டும் sir. மைக் மட்டும் மியூட் பண்ணிக்கோங்க.
மியூட் பண்ணிக்கங்க.
Yes, sir. Thank you, sir. Dear participants, warm welcome to one and all. The sessions will start now.
Respected today resource person, B. Shankar Narayanan sir, dear faculty members, research scholars, students, and other participants. Very good afternoon, all of you. Dear participants, today's topic is input tax credit in GST. This session may be discussed and demonstrated in practical way with examples. The session will be more informative and brainstorming to the enthusiastic participants. I am sure that you will all will feel enriched with knowledge after completion of today's sessions. On behalf of Bharathiar University, I feel honored to welcome resource person V. Shankar Narayanan sir, Chartered Accountant, Chennai, for giving a lecture in this 6th day sessions. I personally thank you very much, sir, for accepting our invitation with your busy schedule. Thank you, sir. I am also delighted to introduce the resource person, V. Shankar Narayanan. He is a qualified chartered accountant and cost and management accountant with 1.5 decades experience in financial and taxation compliances, spanning across diverse sectors including bank, service, and manufacturing sectors. He is a member of GST study group of ICAI. He is a contributor as a part of ICAI team in charge of preparing and updating background material on GST. He is a master trainer of GST, affiliated by Institute of Chartered Accountants of India. He has trained more than 2,000 chartered accountants and 6,000 finance and accounts professionals across India on GST law and practice and indirect taxes. He is a member of Governing Council and Secretary of International Chamber of Indirect Tax Professionals. He is also a member of Indirect Taxes Committee of Hindustan Chamber of Commerce. He is an author of the book namely Gain Smartly Through Senvat Credit Rules 2004. He has acted as a speaker and trainer on taxation at various institutes like Institute of Chartered Accountants of India, Institute of Cost Accounts of India, Institute of Company Secretary of India, Niti Aayog Initiative, Commercial Tax Staff Training Institute, Tamil Nadu, National Academy for Customs Indirect Taxes and Narcotics, Chennai. He is a founder partner in GPVS and Associates, Chennai. So today, such a personality with us. This is the great opportunity is offered by Bharathiar University under RUSA. I trust you that everyone can enhance your skills and knowledge through this session. I hope everyone. I heartily welcome everyone. I thank all of you. Now I request today resource person Shankar Narayanan sir to take over the session. Thank you very much, sir. Welcome, sir.
Thank you, sir. Good afternoon to the participants, the delegates across India who are connected through the virtual mode. At the outset, I want to thank Bharathiar University and especially Mr. Jagadishwaran for such a opportunity being created for interaction. Though we are not meeting face-to-face and interacting, still the interaction is virtual. In a way, it is knowledge enhancing also, investing our time during these testing times. Because when we get time, what we do with it matters. So this is one way in which we can productively engage ourselves. So thank you for that initiative. Without further ado, I think we'll proceed into the discussion for today. Because we have got quite an amount of things to discuss lined up for today. Next 3 hours is going to be jam-packed. If you are a ardent fan of movies, I would say it is going to be a power-packed screenplay for next 3 hours. and I'll try to keep it as much as vivid as possible, as interactive, because in some ways you can also have an interaction in terms of, I'll post some questions, try to give the answers in the chat box. We'll try to see how far we can interact with that. Now, the key discussion today is going to be on ITC, but before getting into the input tax credit concept, let us look at the concept of reverse charge. What is reverse charge mechanism? This is one effective tool introduced way back in, say, 1997, and later on in 2001 onwards, it gained momentum in service tax. Was it not there in the earlier VAT regime? Absolutely, it was there in the VAT regime. There we used to call it as purchase tax. So the way this tax or this payment works is reverse. To put in perspective, what is a normal indirect taxation mechanism? The supplier will supply the goods or services, and he will charge the recipient for the value. What is the value of the goods and what is the tax? And recipient in turn will make the payment of the value of the goods or services plus the tax. Now the supplier has got the right to withhold the basic value because that is his revenue. And whatever tax that he has collected, the supplier is supposed to discharge to the government. So the tax burden is on the recipient. Who bears the burden of the tax is the recipient. But who remits it to the department is the supplier. So this is where indirect taxes are different. So direct taxes, the person who earns the income only pays the income tax. But whereas in case of indirect tax, it is not the person who consumes pays the tax. It is the person who gives it for consumption. The supplier is made to pay the tax. This is what is the normal indirect taxation mechanism. So how can it become reversed? The reversal of it looks something like this. The supplier will supply the goods or service for a basic value. And then the recipient will pay only the basic value to the supplier. But under the legal provisions of the CGST Act, read with the IGST Act, section 5 subsection 3 or 5 subsection 4 of IGST Act, or 9 subsection 3 or 9 subsection 4 of CGST Act or SGST Act, certain transactions, it is not the supplier who is liable to collect and pay the tax. It is the recipient who is liable to collect and pay the tax to the government. So it is not the supplier's liability, it is the recipient's liability to pay the tax. This is what is envisaged in reverse charge. So the recipient will not pay the tax to the supplier. In turn, the recipient will himself pay the tax to the government. Sounds very similar to income tax. Correct? Income tax is the one where the recipient himself pays the tax to the government. Same happens here. The income earner itself pays the tax. The recipient itself pays the tax. That is why it is called reverse charge, and it is exceptional. It is not common. It is not going to happen all the time. It is exceptional. What are all the situations under which such reverse charge mechanism, as we call in a short acronym RCM, reverse charge mechanism, in what are the situations that we will see this reverse charge mechanism coming into play? This reverse charge mechanism in the GST law is of two types. As I said earlier, two sections, separate sections, separately enable this reverse charge. First situation, we call it as notified reverse charge mechanism. Notified means the ones which are by notification by the department. The CBIC issues a notification, Central Board of Indirect Taxes and Customs issues a notification to tell that these goods and these services, I don't want the supplier to pay, I want the recipient to pay. That is what is told in 9 subsection 3, notified reverse charge. Whereas 9 subsection 4 is a unique proposition. Unregistered person, from that unregistered person, if we are receiving an inward supply, then we are liable to pay GST under reverse charge. So two different reverse charges. Both reverse charges are same in terms of mechanism, that is the recipient has to pay, but when it will get triggered. First situation, 9 subsection 3 is whenever it is notified by the government. So it doesn't matter in situations of 9 subsection 3, whether my supplier is registered or unregistered. My supplier is registered or unregistered, irrespective of that, the recipient is only liable to pay GST. That is what is 9 subsection 3. If the government tells that these goods, these services, you are liable to pay under reverse charge. Whereas 9 subsection 4 is a situation where if I am procuring and I am a person who the government has told that I should procure from registered people only. And if I procure from unregistered people, the government says, no, you are a type of person whom I want to procure only from registered people. If you procure from unregistered people, please pay GST under reverse charge for that procurement from unregistered person. Fine. So these are the two key aspects that we need to keep it in mind. 9 subsection 3, 9 subsection 4. Both are equally applicable for goods as well as services. There is no restriction that it is only meant for goods, it is only meant for services. No. Be it 9 subsection 3 or 9 subsection 4, both the cases, either goods or services, can get attracted under reverse charge mechanism. Now moving further, under 9 subsection 3, as I told you earlier, notified reverse charges. What are all those which are notified? When I do the transaction in those goods or those services, I am liable to pay GST under reverse charge. We are first going to see all those goods which if I procure as a registered person, not as an end consumer. If you are procuring it as a registered person, then you are liable to pay GST under reverse charge. In other words, you are procuring it for the purpose of your business. You should be a business. If you are procuring it, then you are liable to pay GST under reverse charge. What are those goods? We are going to see those goods one by one, and you will be able to understand the common theme that is running across there. Raw cotton. When you are procuring raw cotton, the GST registered person who is procuring the raw cotton from an agriculturist is liable to pay GST under reverse charge. So my supplier necessarily has to be an agriculturist. And that is where the government is saying, let the agriculturist not pay GST, being the supplier, but let us shift the burden to the recipient, who must be an industry, who is procuring that raw cotton for the purpose of their industrial use. Maybe they will convert it into cotton yarn. Hence, they are asking the industry to pay the GST under reverse charge, not the agriculturist. Same way, cashew nut. This is not the cashew nut which we are procuring in a bakery or which we are procuring in a nuts and spices shop for our consumption. We are talking about raw cashew nut, which is not peeled, which is not extracted. The raw cashew nut when it is being transacted. So there also the clear indication is who will sell raw cashew nut? Obviously the agriculturist. So the agriculturist need not take the burden of paying the tax. It is the person who is procuring from the agriculturist. Maybe a trader is procuring. The trader is liable to pay GST under reverse charge. And then tendu leaves, popularly known as BD leaves. Who procures it? Obviously an industry, because they want to make that BD out of it, the BD wrapper leaves. Who will sell it? The grower of the tendu leaf, which will again be an agriculturist. So here also they want to protect the agriculturist so that the recipient is liable to pay GST under reverse charge. The recipient will more often than not be an industry, because who will buy tendu leaves and sell tendu leaves? They are only going to buy and convert it into a subsequent product, which is popularly the BD. If they are going to do, anyway BD, there is going to be GST. So why don't you pay on this tendu leaves GST under reverse charge and then take input tax credit also, is what has been told by the department indirectly. And the other type of goods when you procure, you are liable to pay GST under reverse charge is lottery tickets. For two reasons, it will be something which is interesting. Lottery tickets is not legal across India. It is legal only in two states as of today. One is Kerala, the other one is Sikkim. And the interesting thing about lottery tickets is, lottery ticket is considered to be a goods under GST. It is an actionable claim. And any actionable claim is treated as goods, and anything other than betting, gambling and lottery is not even treated as supply. So only betting, gambling and lottery as per Schedule 3 comes under the taxability of GST. There also, lottery ticket, there is a reverse charge. Now you might get a question, sir, who has to pay under reverse charge? It is the a person who's buying the lottery ticket for checking his luck. That is not the person who is liable to pay under reverse charge. The reverse charge is on the shoulders of the distributor. The lottery ticket will be printed by the respective state government. So the government is the supplier of lottery. Who is the recipient? The distributor is the recipient of lottery. Then the distributor sells it to the end customer. Now that transaction, there is no need for any reverse charge. It is the procurement of lottery by the distributor from the state government. That is where they are liable to pay GST under reverse charge. So lottery tickets are goods, and who is procuring it will have to pay GST under reverse charge. The next type of goods on which we are liable to pay GST under reverse charge is silk yarn. Again, something which is grown or extracted from the silkworms, but then it is not used in the same yarn format. It is further taken into weaving as a cloth or a sari or any kind of material, which will only give its value. So the silk yarn per se, that is a GST, but it need not be paid by the one who is doing that silk extraction, silkworm growing. So it goes to the other person. So the liability is on the recipient. Maybe a textile is procuring the silk yarn. They are liable to pay GST under reverse charge. And used or seized goods from government. When the goods are procured, it's a different thing, but government is auctioning it. Used goods, police department has got a lot of used vehicles, they are disposing it off by auction. Whoever is sitting in the auction and taking it will have to pay GST under reverse charge. One. Seized goods. Maybe customs department has seized certain materials for which the person who has got it into India has not paid customs duty. So what they are doing is they are going to give away the customs duty, meaning the customs department is going to take those goods, confiscate those goods, and they are going to give away by way of an auction. In that auction, if you come and procure it, customs department will transfer the title to you. You will become the owner of the goods, but customs department will not collect GST from you. It is the person who is procuring the goods, which are either used goods or seized goods, which I am procuring from the government. I am liable to pay GST under reverse charge. The other type of goods on which reverse charge is mandatory is tobacco leaves. Similar to tendu leaves, tobacco leaves, obviously from an agriculturist, procured by any industry, they are liable to pay GST under reverse charge. And finally, the priority sector lending certificate. Every financial institution, specifically banks, have got a certain percentage of their lending which they must do only to priority sector. They have to live up to that limits. They cannot give all the lending only to commercial activities. They have to give something to priority sector also. That is fixed by the Reserve Bank of India. Some banks will reach it. Some banks will overreach it. They will even go beyond the limit. Some people would not have even touched that limit. They will be falling short. The banks which have overreached, meaning they have already given more than what they are supposed to give for priority sector, they have an option to convert that extra lending as a lending certificate, priority sector lending certificate, and that certificate they can sell it to those financial institutions who are not able to reach. They are falling short. They, instead of going and giving loan at this point of time, they can just procure the certificate from the one who has given more loans and then declare that I have also got enough loans, because by holding that certificate, I am holding that portfolio. This is a very intricate transaction. This happens only in banking and financial institutions, and that priority sector lending certificate happens through Reserve Bank of India, where it is sold by one bank and procured by the other bank or financial institution. The one who is procuring is liable to pay GST under reverse charge. So these are the goods related reverse charges which the person who is procuring it is liable to pay to the department. Now moving to the next aspect, the services. What are all the services which have been notified by the government on which the person who is receiving the service is liable to pay GST? It is not the person who is rendering the service, it is the person who is receiving the service is liable to pay GST under reverse charge. The goods are services. We have already seen goods under 9 subsection 3. Now we are going to expand and see services. Import of service. What is import of service? The supplier being outside India, the recipient being in India, and the place of supply falls in India. In this case, it is considered to be an import of service. And in case of such import of service, who is liable to pay GST? GST is liable to be paid by the recipient in India. The recipient in India is only liable to pay GST under reverse charge. Goods transport agency. Anybody who undertakes to transport your goods from point A to point B, and he assumes the responsibility for transportation of the goods, then that transaction becomes a GTA, goods transport agency service, and that service you are liable to pay GST under reverse charge. So being an industry, I am engaging a goods transport agent for moving my goods from point A to point B. I am liable to pay GST under reverse charge, GTA services. The next one being legal services by a lawyer. Whenever we are taking services of a lawyer, either for representation or for giving opinion or any matter relating to legal aspects, then the service is taxable. Legal services by a lawyer is taxable, but it is not the lawyer who is liable to pay GST. It is the recipient business entity. I am the business entity who is receiving the services of a lawyer. I am liable to pay GST under reverse charge. So that is what is legal services. The next one is arbitral tribunal. In case of an arbitral tribunal, which is under the Arbitration and Conciliation Act 1996, alternate dispute resolution mechanism. Many of the bigger corporates, when there is a dispute in a contract, it is not a issue of whether it is legal or illegal. It is very much legal, but whether it was agreed or not, that point needs to be clarified at that point. That is the point that we want to discuss. Then the arbitral tribunal can be approached, and any fee paid to that arbitral tribunal, the ones who are paying the fee are liable to pay GST under reverse charge. Sponsorship services. Any kind of sponsorship, could be a cricket related sponsorship or any other type of sponsorship, where the person who is receiving the money happens to be the supplier of service. I'll take the current example. Dream 11 has now volunteered to sponsor IPL. So IPL is a spin-off. It is a company which is majorly held by BCCA, but it is a company. IPL Private Limited, it's a company. So IPL Private Limited is the supplier of service. What service they are giving? Sponsorship. Who is the recipient of the service? Dream 11. Okay, so Dream 11 will be charged GST. Yes. Generally, what should happen? The supplier should charge GST and Dream 11 should pay GST to IPL Limited. IPL Limited will pay to the government. But it is in the nature of sponsorship fee. When it is in the nature of sponsorship fee, Dream 11 will have to pay the sponsorship fee to the government. That is a sponsorship fee to the IPL. And then 18% of that GST reverse charge should be paid by them to the department, because it is in the nature of sponsorship fee. Sponsorship, the one who is the recipient is only liable to pay. Any service received from government. If I am receiving any services from government, example, any kind of licenses to operate, maybe in case of an aircraft, license to operate in a route, in case of mining industry, licenses to mine, in case of telecom industry, license obtained for the bandwidth from the government, in case of aviation, or what should I say, the vessel related transportation, I get a route pass from the government. In all these cases, the approval given by the government is in the nature of services provided by the government. Me being a business entity, whenever I receive such services from government, I am liable to pay GST under reverse charge. The other important service, which has been in the thick of things in the last 1 month, 2 months, is director services. A director of a body corporate is rendering services to the body corporate. Then who's liable to pay GST? The one who's receiving the services of the director. Who's receiving the services of director? Obviously the body corporate. The body corporate is liable to pay GST under reverse charge. The other service where the recipient is liable to pay reverse charges, insurance agency services. In case of an insurance agency service, who is the supplier of service? The service is supplied by the insurance agent. Who is the recipient of service? Generally, we will think that I am the recipient of service. We are not the recipient of service. The insurance company is the recipient of service. Because the insurance agent, though he comes and meets us, from us only he takes the money and he says he is doing service to us. It is not service to us. He is actually doing services to the insurance company only. So the insurance company will have to pay reverse charge on the insurance agent commission. Insurance agent need not pay GST. It is the recipient, insurance company, is liable to pay GST under reverse charge. Same way, like in insurance company, we have in banking and financial sector, a recovery agent. Whenever there is an NPA, non-performing asset, it is piling up, they will appoint an agent to recover. Maybe they will go, they will auction the assets, they will realize it, they will go to the court and get an order. All that they do, the recovery agent is only doing, and the recovery agent will take a commission. On that commission, it is not the recovery agent who is liable to pay GST. It is the bank or the financial institution which is liable to pay the GST under reverse charge. The next one is ocean freight, the most litigated reverse charge. Though in service tax it was introduced in 2017 only. There also it was litigated, and GST also it is being litigated. Ocean freight. Are we liable to pay GST under reverse charge on ocean freight? This the department has answered, saying that yes, you are liable to pay, but not on all the ocean freights. For example, I am receiving the ocean freight services from a person who is outside India. If I am receiving ocean freight services from a person in India, he will anyway charge me GST. So there is no problem in that. It is only ocean freight which is paid to a person who is outside India. Then I am liable to pay GST under reverse charge. Any music composer, photographer, or artist whose intellectual property is being used by somebody, I am allowing my music to be used. Ilayaraja allows his music to be played for 1 year. After that, the television company does not have the right to use it. Then for that 1 year, he has given you the right, no, for which you will pay him royalty. That royalty, it is the recipient who is liable to pay under reverse charge. If I am engaging a music composer for my movie, the producer is liable to pay GST under reverse charge. I am engaging a photographer for my company's calendar photo shoot. I am liable to pay GST under reverse charge. I am engaging a painter to make a beautiful sketch or a symbol for our company. I am liable to pay GST under reverse charge. And similarly, another intellect property oriented reverse charge is authors. Author of any kind of book or any publications. It is not the author, it is the recipient who is liable to pay. That is how the legal position was. But from the early part of this year, the government gave an option that either the author can register and pay under normal charge, which means author gets the commission, author gets the royalty, author pays GST on it. It's fine. But if the author is not registered, then it is the recipient who has to pay. So it is a situation where we have to check with the author, sir, whether you will collect GST or I need to pay GST. Because if the author is not collecting, the one who is availing the services of the author will have to pay GST under reverse charge. And this service, the overseeing committee member, is applicable only for Reserve Bank of India. The overseeing committee member of Reserve Bank of India, whatever money that Reserve Bank of India pays them, the overseeing committee fee, the member need not pay any GST. Reserve Bank will have to pay GST under reverse charge. And direct selling agents, the people who call us and always ask, sir, you want credit card, you want loan. These direct selling agent, if he's going to be an individual, he's rendering services to a financial institution, then the commission that this direct selling agent gets, the financial institution will have to pay GST under reverse charge. It is not the direct selling agent. So these are the services under which the recipient is liable to pay GST under reverse charge and not the supplier. So this is reverse charge, the development so far, and the recent additions to reverse charge are any banking facilitator. A banking facilitator is a person who, in a rural area where the bank's branches are present but not very near, still does the transactions on behalf of the bank, goes to the customer, reaches and comes back, acts as a conduit between bank and the end customer. The banking facilitator services, the bank is liable to pay GST under reverse charge. And a business correspondent to a bank or a financial institution, for his services there is no reverse charge, but for the business correspondent there will be an agent, the one who brings the business to the business correspondent, so the business correspondent can take it to the bank. That agent services to the business correspondent. The business correspondent is liable to pay GST under reverse charge. Both are pertaining to banks and financial institutions. The recent addition being security services. Any kind of security services given by a other than body corporate, an individual or a partnership. The one who is procuring the security services is liable to pay GST under reverse charge. The renting of motor vehicle by other than a body corporate. The one who is receiving the motor vehicle is liable to pay GST under reverse charge. My company employees will have to come and go to the office. For that, I am arranging a bus. I am arranging the bus by hiring it from one individual. So in that case, the bus rental, I am liable to pay GST under reverse charge. It is not the individual, because he is not a body corporate. So the individual need not pay. It is me who has to pay under reverse charge, renting of motor vehicle. And then lending of securities, another very unique transaction, specific only to the capital markets. In the secondary market, this is a growing trend. For example, I am a person who is having a vision of holding an investment for about 5 years. I have procured that share. Let's say I have 1,000 shares of a particular company. Now there is another person who is doing trading. He has fallen short of the obligation. Maybe he is doing sell and buy. He is not doing buy and sell, the typical method of trading. He is doing the reverse, short. He is selling and then trying to recover, thinking that the price will come down, but he is not able to buy it from the market. At that time, what he can do is, he can come and ask me to lend the security. If I lend it to him, I will ask a certain fees from him. He is ready to pay that. This is where government comes and says, hold on, securities are not goods, sir. Securities are not services, but lending of securities is a service. The word security per se is not goods, sir. It is per se not service. But lending of security for which receiving money is considered to be a service. And that service, the one who is receiving the money, that is the supplier, need not pay. It is the recipient who is the beneficiary of this transaction, who wants the securities. He is only liable to pay GST under reverse charge. That is what is this lending of securities. Latest reverse charge inclusion for the purpose of services. This is all with respect to the reverse charge services, and few points that one has to be aware of with respect to reverse charges is, whenever it comes to the payment of reverse charge or ITC, the input tax credit or documentation, key points that I want to highlight is that the reverse charge liability can only be paid through cash ledger. That means I can have input tax credit carry forward, but still this month I have got a liability to pay reverse charge. I have to pay the reverse charge to the department without hesitation. I cannot say, I have got this liability, I have already got input tax credit, I will offset. Not possible. I have to pay this to the department only by cash ledger. But if I pay it by cash ledger, will I get input tax credit? Yes. If you are eligible and it is fitting within the provisions of section 16 and 17, which we are going to discuss after this, it is an eligible input tax credit, then you are free to take the input tax credit. So pay the cash and then take the credit is allowed for reverse charge as long as it is eligible. And when it comes to what is the documentation that is associated with reverse charge is that if my recipient is going to be a registered person, obviously he is only liable to pay reverse charge in the situations covered under 9 subsection 3 or 9 subsection 4. But me as a supplier is unregistered. My recipient will pay under reverse charge. In that case, my recipient, what he can simply do is that my recipient can pay. My recipient can pay that reverse charge after raising a self-invoice. Because I am not registered. I am a supplier, I am not registered. So he is paying reverse charge. My recipient will look at the document and he will raise, okay, I am paying to Shankar, Shankar is not registered, so I am going to pay under reverse charge. Then at that time he has to raise a self-invoice. That is the document which is a proof that the reverse charge is being remitted to the department. So that is self-invoice. So these are the 3 key areas. Along with the process of reverse charges, procedures should also be helping us being conversant with the compliance angle of reverse charge mechanism covered under 9 subsection 3 as well as 9 subsection 4 of the CGST Act. As I said at the start, 9 subsection 4, the department has already made it amply clear. Only in case of a real estate, only in case of a real estate developer, they expect the real estate developer to procure everything from registered person. If you are procuring from unregistered person, the real estate developer is procuring from unregistered person, then the real estate developer is liable to pay GST under reverse charge. So the only person as of now in India under 9 subsection 4 who is liable to pay GST under reverse charge is the person who is a real estate developer who is procuring goods or services from unregistered people. The rest of all the people, the industry, any kind of industry, they procure from unregistered person also, they need not pay GST under reverse charge. Because for them it is not mandatory. 9 subsection 4. Procuring from unregistered person, compulsorily, mandatorily liable to pay under reverse charge is applicable only for real estate developer. With that, we conclude our discussion on reverse charge and we move to the core aspect of today's discussion, which is the input tax credit under GST. What is this input tax credit and how does it impact us? First, from a conceptual angle and then procedural. The conceptual angle that I want to highlight is, look at this scenario. Before introduction of GST, this was the scenario. There is a manufacturer 1. This manufacturer 1 is selling the goods at 1,000 rupees and he was liable to pay excise duty of 12.5%. So he is charging 125 rupees as excise duty. He is also liable to pay VAT. So he is charging 14.5% VAT on the amount including excise duty, which is 163 rupees. So together he is able to sell it for 1,288 rupees to the manufacturer 2. The manufacturer 2 will use it for his further manufacture. So in this first transaction, as you can see, the central government would have received 125 rupees as taxes and the state government would have received 163 rupees as taxes. Now the manufacturer 2 procures the goods at 1,288. For him, there is not much of a problem because he is a manufacturer, so he is entitled for VAT credit on excise duty and he is liable for VAT input tax credit also. So look at the key point here. He will take as his cost only 1,000. Though he is paying 1,288 rupees, his cost is only 1,000. The cost is only 1,000. It is not 1,288. Outflow is 1,288. Cost is 1,000. So we will take this 1,000, add a value of 200, which is what is the value addition by him, and he is ready to sell the product at 1,200. When we go and procure that is as a dealer, he will charge as excise duty 12.5%, which is 150, and he will charge VAT also, which is 196. So the final product will come to the dealer at 1,546. This means the manufacturer too will have to pay 150 rupees of excise duty, yes, but he will offset this 150 against 125 because he has already got an input tax credit of 125, 150 he has got output tax liability, and he will pay only 25 rupees to the department net. And then when it comes to 196 rupees, he has to pay as VAT, but he will take the input tax credit of 163. He will pay only 33 rupees to the department. Now comes the key aspect. The purchase cost. The purchase cost for a dealer is not 1,200 and it is not 1,546, because a dealer is entitled for input tax credit only on VAT. He was not entitled to take input tax credit on excise duty. So he will consider his cost to be 1,350. And to that he will expect a value addition of 135. That would in turn make his selling price as 1,485. At this price only, you and me can buy it from the shop, on which a VAT of 14.5%, which is 215 rupees, will be charged. 1,700 is the take-home price for you and me, where rounded off to 20 rupees, the tax will be paid by the dealer, because dealer has got an input tax credit of 196.67 and 215 is what he collects from us. So he'll pay 20 rupees to the department. So all in all, we procure an item for 1,700. The tax inside this 1,700 rupee item is 365. This is how scenario was before GST. Now, when GST came into picture, especially the concept of unhindered input tax credit came into picture. This is what we got to see. Same selling price. The manufacturer one was selling it at 1,000. He sells the same at 1,000 only in GST. Tax rate is only 9 and 9, 18%, 1,180. So the manufacturer 2 was earlier paying 1,288 to buy this product. Now he needs to pay only 1,180. And for him, the selling price is 1,200. It remains at 1,200. But he will collect only 108 and 108 from the dealer. The most important change is the dealer was earlier paying 1,546 to procure the item. Now the dealer only needs to pay 1,416. And out of this, he knows that he is entitled for input tax credit on these two, and he will consider only this 1,200 as his cost. The cost is only 1,200. On that, he gets a value addition of 10%. He is able to come to a selling price of 1,320. On this 1,320, there's a CGST and SGST, which he will collect from us when we go and procure from him. The selling price will be 558, which would mean what was being sold at 1,700 earlier, now after GST should have come to 1,558. There should have been a straightaway price reduction of 8.39%. So how come there can be a price reduction of 8.39%? Look at it. Earlier the government was getting 365. Now the government is getting 238. So it is not the industry which is shouldering the burden. It is the government which has decided to shoulder the burden. And they have decided to take it into 238. Now some of you might wonder, sir, why would the government do this? They were getting good revenue of 365. Why they are going to 238? How did it reduce in the first place? It is because of input tax credit. And why did the government take a policy decision to reduce their income? This is what in any kind of tax that we call widening of tax base. What is widening of tax base? Before introduction of GST, that is on 30th June 2017, we had about 58 lakh registered people in indirect taxes in India. 58 lakhs. Once GST has been introduced, as on July 2020, as on July 31st, 2020, we have about 1.24 crore assessees in India. Where is 58 lakhs? Where is 1.24 crores? Where were these people? Do you mean to say in the last 3 years, all of them have come up to do business? I don't think so. Many of them decided that GST is beneficial for their business, hence they got registered. So earlier there was no registration. They came into registration once GST came into being, which is why they very intelligently, what was being collected from few people, a large amount of tax, now small amount of tax from large amount of people is going to be collected in GST. This is what is the ideal scenario. Now you might think, has it happened? Yes. In most of the cases, the answer is no, because this is where it is stuck. Who needs to revise the price is the dealer. The dealer was earlier selling it at 1,350 plus 215 rupees tax. Now he has to reduce it to 1,200. Then he can collect this tax of 238 from us. But he thinks, sir, why should I reduce? I will keep my amount as 1,350 only, or meaning selling price at 1,485. I will call that 1,485 plus GST. People are already buying it at 1,485. Let me sell it plus GST. And that is what has resulted in the benefit actually accruing to the people, not reaching the end of the spectrum. So this is why GST as a concept is never a failure. The way it is implemented, the way the benefits do not percolate, that is what can result in failure. And in the input tax credit is a major contributory to the GST success, because there is no hindrance. Input tax credit is available to a business subject to certain restrictions. That input tax credit availability will increase their confidence by incurring GST as an outflow, but they know that they will get input tax credit. Thereby, people will start interacting or doing business only with registered people. That is the idea that GST was introduced with. And input tax credit had the product, which I took earlier, had been classified under 18%, 8.39% price reduction should have come. Had that product, suppose, come under GST at 28%, then still there shouldn't have been a single rupee price increase. There should have been a price reduction, because what was sold at 1,700 earlier would have now become 1,690. That's it. Even if the tax rate is going to continue as 28%, but which is not the case. Only 31 items are standing at 28%. The rest of all the items are 18 or below 18 only. So which means even if it goes into that distant possibility, still the tax liability is reduced, and thereby the cost should have got reduced is the concept that we need to have clarity on. Based on this, if we move further, what is the input tax credit and how does it work in GST? How it works, we have already seen. And on what all I can take input tax credit. Input tax credit, I can take on goods or services. Whenever I procure any goods or any services, the one who is giving me the goods or services will charge GST. Can I take input tax credit of the GST? Yes, I can. And that input tax credit, which I am taking, I have to classify it under two categories. Either it is on goods or services. And inside goods, there are two further categories. Is it capital goods or is it inputs? If it is going to be capital goods, the credit taking mechanism is different, or the utilization method is different. It is inputs, there is something associated with it. And when it comes to services, we have to check whether it is strictly qualifying as an input service. So any goods received, any service received is not going to be immediately eligible as input tax credit. Any goods or services that I receive, if they fit in with the definition of capital goods or inputs in case of goods, or if they fit in within the definition of input services, then only I can avail this input tax credit. So what is input tax credit under GST? Input tax in relation to a registered person. So you have to be first a registered person. Then only you can avail input tax credit. That is the basic premise in GST. Any tax under GST, it could be CGST, SGST, IGST, UTGST, or compensation cess. Any kind of that tax paid under GST on inward supplies. I pay on my inward supplies. I am entitled to take it as input tax credit, including while importing goods, I'll be paying customs duty. As part of customs duty, I'll be paying a tax called as IGST. Even that IGST is entitled to me as input tax credit. And any tax that I pay under reverse charge is also eligible for me to be taking as input tax credit. So this is what is the concept of ITC under GST. Now, this three heads that we discussed, what is an input, what is a capital goods, and what is a input service. That is what we are going to see now. Input means any goods other than capital goods. So there is no specific definition. They are going by an elimination process. See whether it is capital goods. If not, I'm ready to call it as inputs. But two more conditions are there. Any goods other than capital goods where it is used or intended to be used by a supplier. Me being a supplier, I should be using it or intending to use it. Maybe I'm putting it to use today, or I want to use it in a later point of time. Used or intended to be used by a supplier in the course or furtherance of business. A very, very, very important condition that one has to fulfill to avail input tax credit. used or intended to be used by a supplier in the course or furtherance of business. Only when it is going to be used in the course or furtherance of a business, I am entitled to take this input tax credit. And if it is other than capital goods, and it is still goods, then only I can call it as inputs. So what is capital goods? That definition needs to be looked at. Capital goods means the value of which is capitalized in the books of accounts. The value of which is capitalized in the books of accounts is called as capital goods. And is it the only condition? No. The value of which is capitalized in the books of accounts which are used or intended to be used. I'm procuring a machinery. The machinery is going to be used. The machinery is not put to use immediately. Can I take input tax credit? Yes, because if you tell me the machinery is intended to be used, then you are entitled to avail input tax credit. And further, that condition still remains in the course or furtherance of business. The usage must be in the course or furtherance of your business. Capital goods, anything that is capitalized in the books of accounts, which is used or intended to be used in the course or furtherance of business, is considered to be eligible as input tax credit. So I'm buying a laptop. Can I take input tax credit? Are you going to use it for your business? Yes. Avail input tax credit. Buying a machinery. Are you going to use it for your business? Yes. Take input tax credit because you are going to capitalize it. As against a tool that is purchased or a raw material that is purchased, what is the difference between a machinery and a raw material? Raw material is not going to be capitalized in the books of accounts. So it will go to the category of inputs. Whereas the capital goods, machinery, which is taken to the balance sheet, you are entitled to take input tax credit on that. And what is an input service? A very, very simple and elusive definition. Any service used or intended to be used by a supplier. So it could be any service which you are using for what? In the course or furtherance of your business, you are entitled to call it as input service and you become eligible to take input tax credit. But we must prove that it is used or intended to be used in our furtherance or course of our business. If we can prove that, even the landscaping of garden in a factory entitled for input tax credit, the housekeeping in a factory entitled for input tax credit, because it need not result directly in the output. It is used in the manufacture. It is used in the course or furtherance of business. If that can be proved, you are entitled to take input tax credit. So three key definitions. What is input? What is input service? What is capital goods? When can I avail input tax credit? We have seen that. Now moving to the next aspect, which is what are the conditions that one needs to satisfy for availing input tax credit? The first important condition is you must be in possession of any one of this document. What is the proof that you have suffered that tax? You have to tell the government that I have suffered this tax on my input. While inward supply is being received, either goods or services, capital goods or inputs, whatever I have procured, I have paid GST. So how do you prove to the department that you have paid GST on that? You need to show your tax invoice. Whose tax invoice? My supplier's tax invoice, because my supplier will charge me GST. Based upon the invoice only I am doing the transaction. So obviously, from my supplier's invoice only I will get to know what is the GST that I have paid to the department. That GST I become entitled to take ITC. Hence, if I take any ITC, one of the primary documents, 95% of the cases we will take input tax credit based upon this document only, which is called as a tax invoice. Second, the RCM related self invoice, which we spoke of a few minutes back. Whenever I am liable to pay GST and a reverse charge, I told you, you are entitled to take input tax credit, but you need to prove that it is paid in the reverse charge. How do we show that it is paid in the reverse charge? We have to raise the self invoice. So when you do that, you are proving to the department that you have paid under self invoice and you become entitled to take input tax credit. A debit note issued by the supplier. When will I get input tax credit on a debit note? The supplier has supplied something to me under the tax invoice. Subsequently, he is increasing the price by way of issuing a debit note. Then I can take input tax credit on the debit note also. Because for invoice also, I am eligible for ITC. The invoice's value is being increased by a debit note. I can take input tax credit on the debit note also. There is no restriction. And in case of import related ITC, based upon your bill of entry, the IGST which you pay on import, based upon the bill of entry, you can avail the input tax credit. That is a proof that you have paid the tax, because when you are importing, the foreign supplier will not charge you GST. The GST will be charged only by the customs department. The GST is got IGST on customs. That, what is the proof that you have paid the tax? You will give the customs department your bill of entry. That bill of entry is the proof that you are entitled to take input tax credit. And then, if you are going to be a person who is availing common input tax credit, then any input service distribution, you are entitled to avail input tax credit. A head office can avail the common input tax credit of all the branches. In that case, the head office will distribute the common input tax credit to the branches. That input tax credit distribution will happen from the head office to the branches by way of a method called as input service distribution. And that input service distribution they have to do by raising an input service distributor invoice, ISD invoice. Based on that, we can avail input tax credit. The other conditions that one has to fulfill for availing input tax credit is, you should have received the goods or services. Then only you become entitled to take input tax credit. But is it practically possible in all the cases for me to receive the goods or services to avail the input tax credit? Practically, there are situations where I will ask my supplier to deliver the goods to my customer. I will not even take delivery of it. I'll ask him, sir, directly go and deliver to my customer. In that case, can I take input tax credit? Yes, because the exception to this provision says, whenever you are directly receiving, it is considered to be received by you. Even when it is received by your authorized recipient, you authorize somebody that somebody can receive the goods, then it is considered to be received by that you only. So you are entitled to take input tax credit. If I take it, if I receive the goods or services, I am considered to be the person entitled to take input tax credit. If I don't receive it, still, if I give it, meaning I authorize somebody to receive those goods or services on behalf of me, I am entitled to take input tax credit when they receive it. So even if my customer receives the goods, my customer is receiving the goods because I have authorized him to receive the goods on behalf of me. So my supplier directly supplies to my customer, I can take input tax credit because it is deemed that I have received it. Because my authorized person, my customer has only received it. That is very, very, very critical in the business scenario these days, because many of the transactions happens by means of a bill to ship to transaction. A person in Chennai is asked to ship the goods to Gujarat, but bill to Delhi. Is it normal? Very normal. Now in this case, can the Delhi person take ITC? Yes, because who is in Gujarat and receiving on behalf of the Delhi person is his authorized person. Then he is entitled to take input tax credit. Second condition. The next condition for availing input tax credit is the tax charged must be the tax that is paid to the department. Whatever tax that we see in a GST invoice, based upon which we take input tax credit. I am the recipient. I receive the tax invoice on which I see the tax. I paid the tax to the supplier, and my supplier is only going to pay it to the government. So can I take input tax credit on the tax invoice? Yes, we can take it, but we need to satisfy this condition also, that whatever tax that is mentioned as tax in the invoice for which you are taking ITC, that tax should have been paid to the government by this person. That tax he should have paid to the government, then only we are entitled to take input tax credit. This is what the recent days the department is making all of us do, which is the GST-R 2A. My supplier reports the invoice against my name, it will come in my GST-R 2A. That they want us to verify and check whether you are entitled to take input tax credit. So that is what happens here. And the next one, a very important condition is, if you do not file your return, you are not entitled to take input tax credit. If you do not file your return, you cannot take input tax credit. No return, no input tax credit. Another logical. If you don't file a return, how would I know that how much ITC you have, input tax credit you have? So please file a return and then take input tax credit. Amendments are being proposed towards this end, but it has not come so far. So as of now, we can assume a person is becoming entitled to take input tax credit. One of the conditions is he should have filed the return. Then only he becomes entitled to take input tax credit. The other conditions, very important condition is this 180 days condition. I am a registered person and I have received your invoices. I am the registered person who has received your invoices. You are my supplier. But after receiving your invoices, that is 180 days from the date of receipt of your invoice, the date of your invoice, I have not paid the basic amount and the tax to you. You have given me an invoice for 1 lakh rupee plus GST. I am supposed to make the payment of that 1 lakh rupee plus GST to you. If I do not make the payment from your invoice date within 180 days, then I am liable. Liable for what? I am liable to reverse the input tax credit, which I have availed. In other words, strictly by GST terms, that ITC that which I have availed should be shown as my output tax liability. I'll repeat, the ITC that I have availed should be shown as my output tax liability. That is what this rule expects. It is rule 37 of the CGST rules, read with section 16 of the CGST Act. So this 180 days is a critical time, and especially during this corona time, the department has not given any leniency in this 180 days, which means, let's say I have received my supplier invoice sometime in February, he raised it in January, but till today, due to financial constraints and my position, I am not able to pay my supplier. Then it is more than 180 days, for which from the date of invoice, I told you the invoice is January. Till today, if I have not made any payment to him, I cannot take the input tax credit. Had I taken the input tax credit, then I should give it back to the department. Is this something which is very unfair? There is a ray of hope in this provision, which says, suppose later on, today I have not paid, so 6 months is over. Today I am reversing the input tax credit. But maybe 1 year later, I am paying my supplier. So what they have said is, if you are paying it at a later point of time, you may avail the input tax credit. You may avail the input tax credit as and when you make the payment. So there is no time limit for the recredit. Rule 37, sub rule 4 says that you want to make the payment at a subsequent point of time. Taken the credit. First, you got the invoice, you took the credit, then you reverse the input tax credit without, for the reason that you have not made the payment within 180 days. And subsequently, you make the payment, you become entitled to take that input tax credit. Whenever you make payment, even if it is 4 or 5 years later also, you become entitled to take input tax credit. That is what is the critical provision pertaining to this 180 days input tax credit. And then the other major component of understanding in eligibility of input tax credits, especially when it comes to capital goods. If I am procuring a capital goods, and on the capital goods, there is a GST portion. I'll give it by way of an example. Look at the example. I'm procuring an asset for 1 crore. On this 1 crore worth of asset, a GST of rupees 28 lakhs is paid. The asset is capitalized for 1.28 crores. That is basic value plus GST. Now, can I take input tax credit? Is the question. Please go through the example. The asset is capitalized for 1.28 crores. Can I avail input tax credit on that? What would be your answer to this question? The answer is, if we are going to avail input tax credit on this 28 lakhs, then we can capitalize the asset only for 1 crore. So if you avail input tax credit on this 28 lakhs, you cannot take the depreciation on this 28 lakhs. But on the other hand, if you are going to capitalize the asset at 1.28 crores, then this GST of 28 lakhs will become capitalized and you will claim depreciation on that. In those cases, you cannot claim input tax credit. So on the GST portion of a capital goods, we have got two options, one or two only, not both. The first option is you can capitalize the GST portion along with the asset value and claim depreciation on it. Situation 1. Situation 2, you can claim that amount as input tax credit, but not capitalize. So either you can capitalize 1 crore and claim 28 lakhs as ITC, or you can capitalize 1.28 crore and you are not entitled for any input tax credit. This is what is a mutually exclusive condition. This 28 lakhs can either be your ITC or your depreciated capital value. It cannot be both. One of the key conditions in availment of input tax credit. Moving to the last part of the conditions for availing input tax credit. What is the time limit for availing input tax credit? The time limit for availing ITC is whichever is earlier of these 2 dates. What are those 2 dates? Due date of filing of return for the month of September of the following financial year. Due date of filing of return for the month of September of the following financial year, or the date of furnishing of annual return. So for example, let us take 2019-20 financial year. The September that is following the end of the financial year is September 2020. The September that is following the end of the financial year is September 2020, which means 2019-20 financial year, any invoice is dated 2019-20. You want to avail input tax credit. The credit must be availed before the due date for filing September 2020 return. September 2020, the due date is 20th of October. Before 20th of October, I should avail the input tax credit. Or the date of filing of annual return. Generally, the due date of filing annual return is 31st December of the following financial year. So 2019-20, the due date is 31st December 20. But this 31st December 20 is a due date. I can file before that also. That is why they have mentioned the date of furnishing of annual return. It is either the due date of filing of return for the month of September of the following financial year, or the date of furnishing of annual return for that year. So 2019-20 financial year, it is either 20th of October 2020, or the date of filing of annual return, whichever is earlier. Generally, we will never file the annual return before September. So it is always beneficial to file the return after September, which means the due date of filing of return for the month of September following the financial year will naturally become the last date by which you should avail the input tax credit. So if you don't avail the input tax credit before that, your credit will become lapsed. You cannot take input tax credit for that financial year, that is 2019-20, after that. That is what is the restriction of this provision, time limit under section 16 subsection 4, saying that you cannot avail input tax credit beyond this limit. So now we move on to the next key provisions, which is restricted and blocked input tax credit. But I think at this juncture we can take a break? Should I check with them? Yes, sir. Can we break for about 10-15 minutes or 5 minutes?
Yes, sir. Yes, sir. We can break for 15 minutes.
15 minutes. Okay. Then I think we will start with the section 17's discussion. Sure.
Okay. 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 Kali Suri? Kali
Yes,
Suri?
sir.
Now break ma for 15 minutes.
Yes, sir. Yes, sir. Dear participants, there is a break for 15 minutes. Please join us back after 15 minutes for the sessions. Thank you. Excuse me, sir.
Yes, ma'am.
Yes, sir. We can start, sir.
Just 2 minutes, ma'am. I'll start. Yeah.
Okay, sir. Okay, sir. Thank you, sir.
Ram felt as if he had another number, as if he was spinning in all directions.
Welcome back. Let's get through the section 17, the critical provisions of what is the blocked input tax credit or restricted ITC under section 17. There are certain situations, even if you are becoming eligible to take input tax credit, even if you are becoming eligible to take input tax credit under section 16's provision, still certain credits are not allowed. It is eligible from a section 16 perspective, but it is not allowed under section 17. What are those? Something is specific to a type of credit, and some of the restrictions are specific to the use for which it is put to. For example, section 17 subsection 1 restricts that any credit which you are availing only for business purpose, any credit which is availed only for business purpose is going to be allowed. If it is not for business purpose, then it is not eligible as input tax credit. Something which is not business related, something which is not pertaining to my business, but on which I have paid GST. It is an inward supply, but it is not used for my business purpose. I'm not entitled to take input tax credit. The second scenario is the common one and a unique situation where my inputs, be it my capital goods or my input services, which I am using for the purpose of doing an outward supply, my outward supply is either exempted or it is going to be something on which no tax is applicable. It is not taxable. When my output is going to be either exempted or not taxable, then I become disentitled to take my input tax credit. If my output is going to be completely exempted or it is going to be completely not taxable, I cannot take input tax credit at all. The issue will come only when part of my output is exempted, part of my output is taxable. Then can I avail full input tax credit? That is where 17 subsection 2, 17 subsection 3, read with rule 42 and 43 of the CGST rules gives an elaborate answer. That answer which it gives is, that is when it is going to be common. My input is going to be common for both my output, which is taxable, as well as which is exempt or which is not taxable. Then how are we supposed to do is, we are supposed to do this segregation. we are supposed to first find out what are all the credits which are pertaining to non-business. The input and input services related credits, which is not relating to my business, identify that. You are not entitled to take that ITC. Second, identify those credits which are blocked by the government. Blocked meaning they will not be allowed as input tax credit. So that should not be taken. Remove the second one. So now what will be left is the credit which seems to be eligible, but there also they want us to do a further research. The credit which is specific to taxable activity and the credit which is specific to exempted activity. The credit which is specific to taxable activity is fully eligible. The credit which is specific to exempted activity is fully not eligible. So the one I have colored in green are the one which is eligible. Specific to taxable is eligible. Sir, I cannot say some of the credits are either specific. I cannot name it as specific. In those cases, treat them as other credits. So from this total ITC, remove what is non-business related credits, remove what is blocked credit, remove the ones which are credit which are specific. And in that specific, what is specific to taxable, avail it. What is specific to exempted, you cannot avail it. Whereas what will remain out of the total credit after removing these three will be generally called as the other credits. Can I avail this other credits? Here also the question is the other credits we can avail proportionately. So the concept of proportioning comes only at this stage. It doesn't come early. So this proportionate input tax credit I can do, and that proportionate input tax credit, how am I supposed to do is in the proportion to my turnover. My exempted turnover divided by my total turnover into the common input tax credit. To that extent, it is considered to be proportionate to exempt. I cannot avail. Exempted turnover divided by total turnover into common ITC is pertaining to exempted. I cannot avail it. On the other hand, taxable turnover divided by taxable turnover divided by the total turnover multiplied by common credit is eligible, proportionate to taxable turnover, and becomes fully eligible. This is how the second part of the credit will have to be interpreted. So the two parts, one is pertaining to taxable, one is pertaining to exempted. Specific credits specifically identify, take only pertaining to taxable. Common credits go for the proportionate mechanism and avail only the proportionate to taxable credit. So this is how the common input tax credit under section 17 subsection 2, when your output is going to be common for both taxable as well as exempted activity, needs to be handled. And this type of scenario is not just for input and input services. This is also applicable for capital goods. In case of capital goods, how it needs to be handled is the capital goods is common both for exempted as well as taxable output. The common example that we can see is, let's say, a milk dairy. That milk dairy is processing milk, and they are also processing it further into a finished product. That is, milk is one of the finished product, and they also process it further into paneer or cheese. Milk as a goods under GST is exempted. Paneer or cheese is taxable. So what it throws out as a problem is the machine which is used for processing of milk is common. That machine is used for both taxable as well as exempted activity. Can I avail the full input tax credit on this machine? The answer is you cannot avail the full input tax credit, but the provisions of Rule 43 allows you to take the credit and then do subsequently proportionate reversal. So avail the ITC on capital goods fully. When should I avail the ITC? You can avail the ITC on day one, full ITC. And then every month for the next 60 months. Sir, why 60 months? That is a general thumb rule under GST. They expect any capital goods to be used for not lesser than 5 years. So 5 years is when converted to months comes to 60. So 60 months is their expectation. So 60 months we take, and the reversal is to be done. How that reversal is to be done? Every month we should take 1 by 60. Take that 1 by 60 and multiply. Multiply with what? Multiply with the common proportion. What is the common proportion? We already know. Exempted turnover divided by total turnover. So every month take that 1 by 60 multiplied by exempted turnover divided by total turnover. The amount is pertaining to exempted turnover. Reverse that input tax credit. Why reverse it? Because you have already availed it. When you have procured the asset, let's say you have procured the asset in August 2019. That time you avail the full input tax credit, but subsequently you are not able to use it only for taxable activity. You are using it both for taxable as well as exempted activity. Then the credit that is availed in August 2019, the total credit, out of that 1 by 60 has to be taken, because for that month only 1 month's credit is equivalent, and that credit multiplied by exempted turnover of that month divided by total turnover of that month we should take. That answer which we get, exempted turnover divided by total turnover into 1 by 60 of the original ITC that was taken, that amount shall have to be reversed as the one which is pertaining to exempted turnover. The capital goods related ITC pertaining to exempted turnover shall have to be reversed in this manner. So this is what is the common ITC reversal. Now, in case of a bank or a financial institution where this common input tax credit will be a major issue, because the majority of their turnover, in case of a bank or a financial institution, the majority of their turnover is exempted turnover. Interest is exempted. Interest on deposits, interest on advances is exempted. So the majority of the turnover of a bank or a financial institution is exempted. Will they sit and do this reversal calculation for all their input tax credits? If they do it, the bank will be able to do only this. They will not be able to do any banking business. Hence, to overcome that, to avoid that, what the government has done is government has given them a simple, straightforward option under section 17, subsection 4. A bank or a financial institution can directly opt for a straightforward method called as 50% ITC. That means they will take only 50% of the input tax credit. On any goods, any services that they receive, they will take only 50% ITC. Then there is no need for them to do this elaborate calculations. Most of the banks and financial institutions have readily opted for this method because of the complexity involved in these calculations. I know very well, in a post-lunch session, discussing such a complex provision itself takes a lot of effort to understand, and that is why I reserved it after the break, hoping that during the break time you would have had tea or coffee, so that would have kept you more energized to absorb this provision. So this is one of the highly conceptual provisions in GST, because the concept of input tax credit, they don't want to give you input tax credit if your output is exempted. The input tax credit actually comes with an obligation. It is a right, you can avail the input tax credit, but the obligation that you have to fulfill to the government is, if I avail input tax credit, I will give you tax. Only if I give the government tax, I can avail input tax credit. That is the assurance that they want. So if your output is going to be taxable only, I'll give you input tax credit. If your output is not going to be fully taxable, it is exempted, or it is going to be not taxable, why should I give you input tax credit? They don't want to give me. But if my output partially is going to be taxable and partial items are going to be exempted, then this proportion calculation will have to be done. Now the next aspect of section 17 subsection 5, where we will be discussing about the blocked credits, situations where we are not entitled to take input tax credit even if all the conditions of section 16 are satisfied, as well as there is no specific blocking as per whatever we have discussed in section 17. There is no such specific blocking, but still department will say you cannot avail this input tax credit. What are those? On the left hand side, I've given the type of credit. On the right hand side, I have discussed the exceptions. Motor vehicles or other conveyances which are meant to ply on the road. So on this motor vehicle and other conveyances, department has said that I will not give you ITC. But on the exception side, what they are saying is, I will not give you ITC if the seating capacity is not more than 13 persons, including the driver. So if it is a motor vehicle where the seating capacity is more than 13, you are entitled to take input tax credit. That is what is the meaning. For a car, I cannot avail input tax credit. Whereas for a bus, minibus, I can avail input tax credit because the seating capacity is more than 13. Seating capacity is going to be more than 13. I can avail input tax credit on the motor vehicle. So this question of 13% seating capacity is applicable only for a passenger vehicle. If it is going to be a goods vehicle, the 13% seating capacity logic does not apply because it is not meant to carry passengers at all. So in case of goods carrying vehicle, how much however small it is, how much however big it is, as long as it is a goods carrying vehicle, you are entitled to take input tax credit without any doubts. And even for the vehicles where the passenger seating capacity is up to 13 persons, including the driver, that is the seating capacity. Let's say seating capacity in case of a typical car, 5, including the driver. Can I take input tax credit? Yes. 3 situations they say that we can take input tax credit. What are those 3 situations? Situation 1, supply of such vehicles or conveyances is my business. That means I buy car and I sell car. Can I take this input tax credit? Yes. Or if I use that vehicle for transportation of passengers, in that case, yes, I can take input tax credit. The third one is the exceptional situation where I use the vehicle for teaching driving, imparting motor driving skills. In those cases, that is when my business is buying and selling of car, even if it is below 13% seating capacity, I am eligible to avail input tax credit. When my business is transportation of passengers, even if I am using a vehicle which is lesser than 13% seating capacity, I am entitled to take input tax credit. And when I am using the vehicle for imparting motor driving training, then in those cases also, I am eligible to avail input tax credit of this vehicle which I am using. So as I said at the start, this is applicable and these restrictions are only in respect of a passenger transport vehicle. If it is a goods transport vehicle and it is used for the purpose of your business, no restriction, avail input tax credit, no blocking. Next. This motor vehicle which we have procured, we are incurring running expenses like general insurance, services, repairs and maintenance. What will happen in these cases? If you are incurring that running expenses like general insurance, servicing, repairs and maintenance, please see to it that only if the vehicle is eligible, the ITC is also eligible. I'll repeat, only if the vehicle is eligible, the ITC is also eligible. If the vehicle is not eligible, the insurance pertaining to that vehicle is also not eligible. I'm taking insurance on the lorry. Is lorry eligible for your business as capital goods? Yes, sir. Then the insurance on lorry is also eligible. Whereas I am incurring repairs and maintenance of the managing director's car. Can I take ITC on that? Not possible, because car per se is coming under the passenger seating capacity less than 13. So you cannot avail that ITC. When the car you cannot avail ITC, the car related expenses also you cannot avail ITC. This is what is the restriction imposed in the blocker credit concept. And the third aspect will be even more interesting. Any leasing, renting or hiring of motor vehicles or vessels or aircraft Even if I am leasing it only, it is not my car, I am only hiring it. Leasing, renting or hiring of motor vehicle, I am doing only that. Can I take input tax credit on that leasing, rental or hiring? You can, but only if you have the motor vehicle passing through the criteria of 13% seating capacity. If it is going to be a goods carrying vehicle, then any kind of leasing, renting, hiring automatically becomes eligible. If it is not even a motor vehicle, it is going to be a vessel or an aircraft, that also becomes eligible immediately because it is goods carrying. Whereas if it is a passenger motor vehicle, then even on renting of it, it must be more than 13% seating capacity. Then only ITC becomes eligible. That is what is this third restriction or blocked input tax credit pertaining to motor vehicle. So the first part of the motor vehicle credit eligibility is the 13% seating capacity passenger transportation, and the 13% seating capacity will extend not just for the money paid on the motor vehicle, it will be, that is the cost of buying the motor vehicle, it will also be applicable on the running expenses pertaining to the motor vehicle. And it is not my vehicle at all, I am only renting it or leasing it. In that case also, this provision can come in and say the vehicle is lesser than 13% seating capacity, even the renting, leasing or hiring is not eligible as input tax credit. So these are the provisions pertaining to motor vehicle blocked ITC. We now move to the next blocked input tax credit. Any food and beverage or outdoor catering or beauty treatment or health care services or cosmetic surgery. Any of these services, if it is taken by an organization, is not eligible for input tax credit. Any food and beverage given to anybody, be it employees or be it to anyone else, there is no input tax credit, including outdoor catering, beauty treatment or health services, maybe a gym membership or any cosmetic surgery. All these cases, input tax credit is not eligible. But there is an exception. The exception is the ITC is eligible if it is used for a similar nature service. That is, I am an outdoor caterer. I am buying food for doing my outdoor catering service. Can I take input tax credit? Yes. One. And the situation where this is being given as part of my total supply. For example, we are attending a training. These days, we are attending only online training. Let us assume that after all these problems are over, we have a face-to-face training. At that time, we are attending a training. The training is a full-day training. So obviously, the lunch is also included as part of the training. But is the lunch predominant in the fee that we pay? Lunch is only an incidental thing. It is part of a composite supply or a mixed supply. But the person who is providing us the training is collecting the total fees for both the lunch as well as the training fee. So can he take input tax credit of the food bill that he is going to get? He can, because he has not consumed those food. He has only used that food as part of his mixed or composite outward supply to us. So he is entitled to take that input tax credit. So these are situations under which even these credits can be availed. And there is one more situation where it is legally mandatory on the part of the employer to provide such food or beverage to the employee. In that case also, they can avail the input tax credit. For example, Factories Act says that if you are going to employ more than 250 people, you are entitled to take that input tax credit. So that is where this will also come in. So those situations which are exceptional, we can avail, but generally the credit cannot be availed on these services. The other input tax credits which are blocked under section 17 is membership of a health club. Maybe for the director, for the managing director, or for employees. It is paid by the company, not eligible. Health and fitness center, paid by the company, not eligible. Travel benefits to the employees who are proceeding on vacation. It is not official travel. It is travel on leave. For that purpose, any benefit is given to the employee, that credit is not available, that is not eligible. And the other service which is directly blocked by the provisions of section 17 subsection 5 clause C is that any works contract service for immovable property. What is an immovable property? Anything that cannot be removed without causing substantial damage is considered to be an immovable property. And any kind of works contract service which is done in relation to an immovable property, they are saying you are not entitled to take input tax credit generally, but exceptionally you can take if that works contract service is used for the purpose of a plant and machinery. I am working on an immovable property, but that immovable property becomes my plant and machinery, then I become eligible to take input tax credit. One. Second, when I take this works contract service input for the purpose of doing my output, which is also works contract service. My input is works contract service, my output is works contract service, then I become eligible to take the input tax credit on works contract service. So this is what is the blocked credit. And what is plant and machinery for the purpose of GST, especially for the purpose of this provision, has been specifically defined. Plant and machinery includes anything that is fixed to earth, but it does not include any land, building or civil structure. Mere building or civil structure will not be called as plant and machinery. Maybe it is adjoining, attached to a asset, then only it will be called as building or civil structure. Attached to a machinery, then only it will be called as part of plant and machinery. And then telecom towers will never be called as plant and machinery. Pipelines which are laid outside the factory premises can never be called as plant and machinery. So the B and C, telecom towers and pipelines, are directly hitting the telecom industry. The major assets of the telecom industry are their optical fiber cables. And all these optical fiber cables are laid outside by way of pipeline only. And telecom towers, we have to have it everywhere, so that is when they can effectively communicate, meaning the network connectivity will be there. So that is another situation. So these are the blocked credits pertaining to works contract. Moving further, the other blocked credits, any construction of immovable property, the goods which goes into the construction or the services which go into the construction are not eligible to be taken as input tax credit. Factory is being constructed, you cannot avail ITC. Why, sir? Because the factory itself is an immovable property. It is not plant and machinery, so you cannot avail that ITC. But whereas, if the construction of an immovable property which results in a plant and machinery, then you are eligible to take input tax credit. And even if a person is constructing an immovable property on his own account, which means I am a hotelier, I want to construct a hotel which I want to let it on rent. I am buying material, I am organizing for labor, they are doing the work for me. Even if the constructed hotel is going to be used in the course or furtherance of business, I am not entitled to take this input tax credit. That is what is the blocked input tax credit pertaining to construction. So by reading this 17 subsection 5 clause C and D, it is easy to think that the government does not like ITC to be taken on construction or construction related activity. Your assumption or your inference seems to be logical, because that is what they have been telling repeatedly. Either it is works contract or it is construction. Both the cases you are not entitled to avail input tax credit unless it is going to result in a plant and machinery. Even if it is going to be used for the purpose of your business, you are not entitled to avail this ITC. Now, moving on, the other blocked credits are goods which are lost, stolen, destroyed, or written off. Let's take one by one. What is lost and in what way it is different from stolen? Goods lost are the ones which are gone, but it is not major. We call it by a term in costing called as pilferage. It is lost, but it is not as big that I'll make a police complaint, I'll make an insurance claim. No. Maybe out of 100 screws, only 60 are there. Or goods lost. Goods stolen. What can be goods stolen? Now here, I know that very well that I am being deprived of the asset. The goods are not there with me. Somebody has taken it away from me. In that case, what am I supposed to do? In that case, you are supposed to reverse the input tax credit. So in case of goods lost, reverse input tax credit. In case of goods stolen, reverse input tax credit. In case of goods destroyed, destroyed by what means? Any man-made disaster or natural calamity. Because of that, goods have got destroyed. It is not usable. Then the credit that is availed shall also be blocked. You cannot avail that credit, you'll have to give it back to the department. Goods which are written off. I think this is one word only the accountants will understand. Written off. What is a write-off? Write-off is an activity where physically it might be there, but from the books it is taken out. When we do such a transaction, when we write it off from the books, then in those cases, we are supposed to reverse the input tax credit also. You cannot enjoy the input tax credit as well as not have it in the books. It should be in the books. Then only your ITC is logical and it is allowed. If it is not in the books, then it is not considered to be allowed. So it should be in the books. And goods which are disposed of by way of gift or free samples are also not eligible. The credit should be reversed. What is the difference between a gift and a free sample? Generally, a gift is the one which I procure and give it to you. So I may not be the one who's manufacturing it. But whereas free sample is, I have it and I give it to you. So let's say I am a manufacturer of medicine, pharmaceutical company. I manufacture a lot of medicines. Out of this, 6 to 7% is always given away as free samples. When I give it away as free sample, what is it? Is it blocked credit? Yes, because you're not earning anything out of it. So it is considered to be a blocked input tax credit. Any goods lost, stolen, destroyed, or it is written off for an accounting purpose from the books of accounts, or when it is disposed of by way of gift or free samples, the credit on those goods becomes ineligible and you will have to give it away. You have to give it back to the department by way of reversal. It is a blocked ITC. The next situations that we are going to see is under section 18, special scenarios. What are those special scenarios? Scenario 1 is, I am a person, I am an unregistered person. So far, I was an unregistered person. Or I was a person who has opted for composition scheme. Or I was dealing only with exempted items. I was an unregistered person, or I was under composition scheme, or I was dealing only with exempted items. All this means one, that is, so far I was not eligible to take ITC. Being an unregistered person, I become ineligible. Being a composition person also makes me ineligible to take ITC. Being a person dealing with exempted items also makes me ineligible to take ITC. But suddenly there is a change in my status. What is the change in my status? Now, I become a normally registered person. How can somebody who is so far unregistered or so far coming under composition or exempted can become a normally registered person? Possible. Because I have got myself registered, or I have moved away from composition, either because I crossed 1.5 crores or due to my business compulsions. I've come out of composition, then I become normal. The goods which I am dealing with so far, which were exempted, suddenly has become taxable, or I have started dealing in other goods also which are taxable. In all these cases, from being a person who is not entitled to take ITC, who is not even liable to get registered, you become a normal registered person who is liable for this GST liability. When you become liable for GST, the obvious good thing that comes along with it is you can avail input tax credit. So can I avail this input tax credit? Yes. And this is where section 18 comes in and says, whatever is your ITC, I'll repeat, whatever is your stock which is lying on this day, that is the day from which you become a normally taxable person, from being this, you are moving here. On this day, whatever is your inventory, on that inventory, whatever credit is lying, that you can avail as input tax credit. The amount of GST that which you have paid on the inventory that is lying with you. So if you have already paid GST and the stock has been sold, on that you cannot avail. The stock should also be there and it should have suffered GST. The proof of that is the invoice. And that invoice is within the last 1 year. If that is going to be the case, then you can avail this input tax credit when you are moving into normal registration. So that is what is the first scenario. Then the next special scenario is the reverse of it. So far, I was a normally registered person, but due to various reasons, could be the business is dull, or I myself intend to move to composition scheme, or my goods have suddenly become exempted, so there is no need for any GST to be paid. In these scenarios, the reverse happens. So far, I was continuing as a normal person with all the ITC, but now suddenly my ITC claim is gone, meaning I cannot take input tax credit, but for whatever stock that is there with me on this day, the day from which I'm going to go out of normal registration, the credit on this day, I shall have to reverse. What is the credit lying in my books? No, it is the credit that is attributable to the stock, the inventory that is lying with you on this day. In the earlier case, we had availed the ITC which is on the inventory which is lying with you on this day. Now, in this case, we are going to reverse the ITC on the inventory that is with you on this day. Because from here onwards, you're not going to pay GST. Which means, why should I give you input tax credit? Please reverse the input tax credit on your inventory, which you have availed and you might have utilized or you may not have utilized. Doesn't matter. On the inventory, had you availed ITC, please reverse that ITC and go into the next situation. That is the situation where you will not be entitled to take ITC. And then the other situation can arise here is section 18, subsection 6, which is disposal of capital goods. I'll come to that. But the disposal of capital goods needs to be understood very thoroughly through a practical example. I am buying a capital goods. This capital goods, I have taken ITC on the capital goods. So the ITC, that which I have taken on this capital goods, I am encountering a situation where the capital goods are being disposed. The capital goods which I have procured is now being disposed. When it is getting disposed, the capital goods which I procured, section 18 subsection 6 comes in and says that you are liable to pay GST. Yes, I know very well that when the capital goods are being disposed, I am liable to pay GST, but it is prescribing a method to be followed based upon which we are supposed to pay this GST. So what is the method that is suggested and how to do it? That is something which I want to take you through. A very important provision pertaining to capital goods. Just give me a minute. I'll share my Excel and then there we'll be able to see it. I hope you are able to see my screen, which is the blank Excel. I'll take you through the assumptions in this. Let's say I have purchased an asset, a capital goods on 1/1/2018. I have purchased this capital goods. This is the date of purchase. The date of purchase is 1/1/2018 and I have purchased it for a value. The value of the asset is, let's say, 10 lakhs. And for this 10 lakhs worth of asset, I have paid a GST of 18%. So this is the initial data which is given. Now this is a capital goods. So this is a capital goods under GST, and I have taken the input tax credit on it. So when I am selling it today, let's say 24th August 2020. I'm selling it today. I'm selling it for a price of, let's say, 4 lakh rupee, because it has been put to use. So generally what we will think is, okay, you are selling it today for 4 lakhs. What is the GST rate today? Today is also 18% for the same item. So 18% is 72,000. We will think that we are liable to pay GST of 72,000. But since it is capital goods, this is where the importance of capital goods is stressed under section 18 subsection 6. Since it is capital goods, it is not the 72,000. What is the 72,000? It is the tax on transaction value. It is not on this tax on transaction value that we are liable to pay GST. They want us to calculate one more thing. That one more thing is how much is the ITC that which you are not eligible. So they want us to calculate ITC on capital goods. Ineligible. How to find out the ITC on capital goods for which I am not eligible? What we need to do is we need to take, how to calculate this is, take the total ITC on the capital goods less eligible ITC. So ITC on capital goods which is ineligible is equal to the total ITC on the capital goods less eligible ITC. Okay, again we are ending up with the term eligible ITC. What is eligible ITC? That is what has been told in 18 subsection 6 as eligible ITC is equal to 5% per quarter or part of. Eligible ITC is equal to 5% per quarter or part of a quarter for which this asset has been held by me. So for how many quarters I have used this asset? Let's take the calendar year. Calendar year of 2018. Have I used it for the full year? The answer is yes. I've used it for the full year. So I will take the number of quarters as 4. And for 2019, I've used it for 4 quarters. Perfect. And for 2020, how many quarters have I used it for? I've used it for first quarter, certain. Up to 31st March 2020, I have used. Up to 30th June 2020, I have used. Yes, 2 quarters, certain. I have used it only up to 24th August. Is that a problem? I have used for not a full quarter, only a part of a quarter. As it has been told here, eligible ITC is 5% per quarter or part of a quarter also. So here we are entitled to consider it as 3 quarters. There is no issue. First quarter ending March, second quarter ending June, and the third quarter ending September can also be taken because it is used for part of the third quarter. So which means for how many quarters I have put it to use? I have put it to use for 11 quarters. Per quarter, I am eligible for 5%. So now I am eligible for 11 into 5%. I become eligible for 55%. 55% of what? 55% of the total ITC which I avail. So I am entitled and eligible for 99,000. So this is my eligible ITC. So we have got only to the first system. We have got the eligible ITC. What is the ineligible ITC? So ineligible ITC is equal to we have to take the total ITC. My total ITC is 1,80,000 minus the eligible ITC less eligible ITC is equal to my ineligible ITC. My ineligible ITC is 81,000, and now I have a comparison to make. The comparison is between tax on the transaction value. What is the tax on the transaction value? The transaction value is 4 lakhs. I'm selling it for 4 lakhs. So if you're selling it for 4 lakhs, 72,000 is the tax liability. But since it is a capital goods, you are selling it without putting it to use for 5 years. You are entitled only for 55% of the ITC, which is 99,000. So you are not eligible for 81,000. Is it 72,000 or 81,000? Whichever is higher. You have to pay 81,000 to the department in this transaction. So you are selling it only at 4 lakhs. You are liable to pay GST of 81,000. This is what section 18, subsection 6 tells us. A very, very intricate provision. And the purpose of the provision is to make it clear that if you say that I am procuring a capital goods, you have to use that capital goods for 5 years. If you are selling it within 5 years, I don't have a problem of you selling, but please ensure that when you are selling it, it is either this amount, the tax on the transaction value, or the ITC on capital goods, which is ineligible, higher, is paid. Now, I'll just twist this example. What if I am selling this asset for, instead of 4 lakhs, I am selling it for 6 lakhs. Then what happens? In this case, look at the difference. The tax that is payable is 1,08,000, because now the tax on the transaction value is higher. The ineligible is still remaining 81,000. So which is higher? 1,08,000. You will be asked to pay GST of 1,08,000 rupees on this sale. So as a prudent accountant, whenever we are analyzing the situation of capital goods, we have to think, what will be the useful life of the capital asset? The life of the capital asset is not going to be more than 5 years. Then we will always end up with this calculation, because whenever we are disposing it, this calculation has to be done. But if the useful life of the asset is going to be more than 5 years, and we also have an intention to use it for 5 years, then this will never be a problem. Because the moment you use the capital goods for 5 years, what happens is that the eligibility, you will become 100% eligible, because 5 years means every year 4 quarters. So 5 into 4, 20 quarters. 20 into 5%, 100%. You will become eligible for the full credit. Then you need to pay GST only on this transaction value. You don't have to worry about calculating both and taking whichever is higher. You can directly pay it on the transaction value. That is the benefit that which we have to analyze and guide people in terms of capital goods related ITC. And this is one of the special circumstances noted and envisaged in section 18, subsection 6. We'll get back to our presentation. Yeah. The miscellaneous provision under input tax credit, which pertains to job work. Job work is an activity where the goods belong to me, but you are doing a treatment or process on those goods. I'll repeat, the goods belong to me, but you are only doing a treatment or process on those goods. What you are doing to me is called as job work. You are a job worker. The work that you do to me is called job work. Now, in this case, something unique happens. My goods will come to your place and you will process it and send it to me. So generally, when goods are supplied between one person to another person, we are liable to pay GST. But job work is one scenario which the law takes into consideration and says, in case of job work where you are moving goods from one person to another, you don't have to pay GST because it is not a supply. It is only going to the job worker as a matter of adding value and it will come back. Hence, you don't have to pay GST. But moment it is told, people might start misusing the provision. So the department is also equally aware. So they have got some conditions which we need to fulfill. You are entitled to enjoy this tax holiday. What is that benefit that they have given is you have the power to send the goods to a job worker without payment of any tax. But the condition is the inputs must come back within 1 year. The inputs must come back within 1 year. So any raw material that you are sending to them shall have to come back within 1 year to us. If it is not coming back within 1 year, then department will deem it to be a supply. If the inputs are not coming back within 1 year, the department will deem it to be a supply under GST. Same way, capital goods, if you are sending it to a job worker, it should come back within 3 years. If it is not coming back within 3 years, then the department has the right to call the capital goods as being supplied and you are liable to pay GST on it. So I'll repeat, if it is an input which is sent to a job worker, it has to come back within a time span of 1 year. And if it is going to be a capital goods that is sent to a job worker, because the capital goods will be used by the job worker for finishing the product. If it is a capital goods which is sent to a job worker, it has to come back within 3 years. And this period of 1 year or 3 years can be further extended by the commissioner. The commissioner of GST for a further period of 1 year or 2 years. That is, inputs from 1 year can be extended for 1 more year, and capital goods from 3 years can be extended for another 2 years. So totally it can be 5 years. So inputs 1 year can become 2 years, but that is exceptional. We have to get written approval for extension from the commissioner. Only then it is possible. And the time limit within which the capital goods will have to come back, the 3 years time limit, is not applicable in case of mold, dies, jigs, or fixtures. These are small items, or I would say value-wise they might be big also, but generally these items are not expected to be used for a longer period of time. So in case of these molds, dies, jigs, and fixtures or tools which go to a job worker for the purpose of performing, even if they do not come back, there is no deemed supply. But that is the only exception that we have. In all the other cases, whether it is raw material or whether it is capital goods, when it goes to the job worker, it has to come back within the timeline. The timeline being inputs is 1 year. In case of capital goods, it is 3 years, further extendable by 1 year or 2 years as the case may be. And then, as I said earlier, if the goods are not returned within the prescribed time limit, it will be deemed to be a supply. And the painful part is that it will be deemed to be a supply on the day on which it was sent. So it will become actually a retrospective supply. And you are liable to pay GST with interest on the retrospective supply. And the other procedures that are pertaining to a job worker is, whenever we are sending goods to a job worker, we have to send the goods under the cover of a challan that is called as a delivery challan, and the delivery challan should be specifically marked as delivery challan going to a job worker. And a person who is engaging any job worker to whom the goods are, who is the principal, who is in charge of those goods, will have to file a form called as ITC-02. This form should be filed on a quarterly basis. The statement should be filed on a quarterly basis by the who is engaging the services of a job worker. And that have come back, all that he has to prove by way of submitting this form ITC-04. And the last part of our today's discussion is input service distribution. What is an input service distribution? Is, as I said at the start, I am a head office and I receive inputs, the input services pertaining to all the branches or all the units which are across India. All the services I receive. Now, all these services together, I take input tax credit, but am I eligible to take all that input tax credit and utilize it in here itself? That is, my head office is in Chennai. Can I take all the input tax credits and utilize it in Chennai itself? And will it be logical? Will it be acceptable by the department? There can be a problem because the credit actually pertains to every unit or other units which are outside Tamil Nadu. How can you avail the input tax credit here itself and say that the input tax credit, everything pertains to Tamil Nadu, which is not considered to be correct. For avoiding this provision only, what they have told is this person who's in Tamil Nadu, apart from being normally registered person, can also get registered as an input service distributor. By getting registered as an input service distributor, what do they gain? All those common invoices can be obtained by them. All those common invoices can be obtained by them in their name itself, the ISD's name itself, input service distributor's name itself. And then using the input service distributor registration, they can distribute the credit to the other units. And who is this ISD? This ISD, input service distributor, is considered to be a person who is not liable to pay GST, but who has got the responsibility only to avail the input tax credit and distribute it among the units for whom it is common. If it is not common, it is pertaining to one unit only, they should distribute to that unit only. They should still not forcefully distribute it to everybody. They can distribute it to the ones to whom it is common, to whom it pertains, to them only they can do. And further, what is the basis on which they can do this distribution? This distribution can be based upon the turnover of the respective units in the previous year. Suppose previous year is not available, then they can do it as per the previous quarter. And they can distribute the central taxes as CGST itself, or they can distribute the central taxes as IGST, or they can distribute the state tax as CGST itself, or distribute it as IGST, which means I am in Chennai, I receive an invoice from another person within Tamil Nadu, I will get only CGST, SGST invoice, but I am an IST who's sitting in Tamil Nadu. Now I want to distribute it to outside Tamil Nadu, then in that case, I can do the distribution outside Tamil Nadu as IGST. I am empowered to do that. So that is the other salient feature or power that is given to a specific type of registration under GST, which is meant only to distribute input service related credit. It is not input credit. They cannot distribute all the input tax credit. They can distribute only input service related credit, and they have been empowered under the provisions of section 20 and 21 of the CGST Act, which is the last part of our discussion today on the input tax credit related provisions. With that, what we have done is we have come to the end of the session where I can take some questions from your end if you have.
Yes, sir. Thank you for the wonderful session, sir.
Yeah.
Yes, sir. There are some questions from the participant side, sir.
Okay.
Yes, sir. Though capital goods under ITC calculation difficult by working in Excel. So just a second, sir. Dear participants, if you have any doubt, you can post your questions in the chat box. Sir, up to what amount exempted in reverse charge mechanism?
There is no exemption for reverse charge mechanism. Any amount of liability that you have to pay. There is no exemption.
Yes, sir. Sir, an example for input tax credit?
Example for input tax credit. It could be any of the input invoices that which you are receiving. For example, let's say I'm buying raw material. The raw material invoice, I can take input tax credit based on that. I'm getting the services, let's say audit fee. Audit fee service, I can take input tax credit.
Okay, sir. Sir, if the value of capital goods become nil, how to calculate?
The value of capital goods becomes nil, but you will be still selling it at some value, no? If it is going to be nil value, even when it is being sold, then there is no sale. If you say that there is a sale, then pay tax on the sale value only.
Okay, sir. Sir, we can take ITC on bank charges. Can we take ITC on bank charges, sir?
Yes. Generally, bank charges are incurred for the purpose in the course or furtherance of business only. We can certainly avoid.
Okay, sir. Sir, I have purchased a laptop for office use. Can I take ITC on this? I am planning to take depreciation on laptop also.
See, you can take ITC and take depreciation also, but let's say the laptop is 50,000 and the GST on it is 9,000. If you capitalize the laptop for 59,000, you cannot take ITC. If you capitalize the laptop for 50,000 and 9,000, you can take ITC. And please remember, you have to use it for 5 years. That 60 months calculation will come.
Okay, sir. Sir, can you please explain PSLC once
Yes,
again?
the priority sector lending certificate, which we discussed. See, I am a bank. I am having, let's say, 1,000 crores of advances. There is a provision in the RBI that which says I should have lent minimum 10% out of 1,000 crores, 100 crores I should have lent to priority sector, maybe agriculture or agri-oriented sector. But I have not lent it to agri or agri-oriented sector. I have got 1,000 crore and 1,000 crore I have lent only to commercial entities. At the end of the year, RBI will ask me this question: why you have not done the lending to the priority sector? To avoid that question, what will I do is, there is another bank. That bank, they should have lent only 1,000 crores, rather of their total 1,000 crores, they should have lent only 100 crores to the priority sector, but instead they have lent 400 crores to the priority sector. So now what I will ask them to do is, sir, do one thing. You have lent 300 crores extra. That 100 crores, remaining 100 crores, please give it to me. How will I get it from them? They will give it as a certificate to me saying this 100 crores, we are transferring the portfolio to this banker. So I can take it from them and I can call by investing on that priority sector lending certificate that I have actually lent that 100 crore. And it is not them who has lent 400. Now their 400 will become 300 and my 0 will become 100. I can prove to RBI that I have done priority sector lending. This I do by way of purchasing a certificate from them. That certificate is considered to be goods. On that, me as a recipient is liable to pay GST under reverse charge.
Okay, sir. Sir, input can be taken if output is exempted. What about exports?
If output is exempted, you cannot take input tax credit. But if your output is exports, export is not exempted. Export is called as zero rated. If your output is zero rated, you are entitled to avail input tax credit.
Okay, sir. Sir, can financial institutions claim ITC?
Yes, financial institutions can claim ITC. As I said earlier, 17 subsection 4, they have to be aware of that provision so that they don't do this reversal all the time. They can take 50% input tax credit, which is allowed.
Okay, sir. Sir, can you explain any practical circumstances where the GST on purchases are more, but GST collected on sales is less? And amount with the department is more, and how do they claim ITC in this case?
There is a possibility, we call it as inverted duty structure. In the refund session, our CA Bhuneshwari will take you through that, but I'll just give an introduction into it. Inverted duty structure means my inputs are coming at 18%, but my output is only 5%. In that case, my output, whatever high amount I sell, I will not be able to exhaust my input tax credit. So that can happen. And how to claim it as refund, please watch out for the presentation by Bhuneshwari, which should be coming in this week.
Okay, sir. Sir, whether it is between only public sector banks to private sector banks?
No, PSLC is applicable across. It is a process which is facilitated by Reserve Bank of India. So all the banks can participate inside that.
Okay, sir. Sir, can you give an example for time limit to avail ITC?
Time limit to avail input tax credit. Okay. There is an invoice which I have in my hand today. But that invoice is dated 1st January 2020. 1st January 2020 is the date of that invoice. I'm holding it today. It is pertaining to one of the raw material that I have purchased. So am I eligible to take that input tax credit? Yes. it is used for the purpose of my business, I can take input tax credit. But the problem that I have now is that the financial year in which the invoice was raised is already over. The invoice was raised in the financial year 1920, and 1920 is over. We are now in 2021. Can I avail input tax credit of this invoice? The answer to that is in 16 subsection 4, which says that you can avail input tax credit, provided it is before the due date of filing of return for the month of September. What is the due date of filing of return for the month of September, which is following the end of the financial year? 1920 is the financial year. Financial year is over. So what is the September that is following is September 2020. September 2020, what is the due date? 20th of October 2020. Have we crossed 20th of October 2020? No. So you can avail the input tax credit. So, but there was another condition, no, that the annual return date, annual return due date, as I told you, is December. So nobody will file before that. Hence, I'm assuming in this case, since I have not filed the annual return, the due date of filing the return for the month of September or the date of filing annual return, whichever is earlier, up to that I can avail. So far, I have not filed my annual return. Then I can avail this input tax credit. Suppose if I have filed the annual return on 14th August, then today I cannot avail the input tax credit of that invoice. Though September of the following financial year has not come, but I have already filed my annual return, I cannot take it.
Okay, sir. Sir, if tax paid on inputs at 18% and tax on output supply at 5%, can we claim refund?
You can claim a refund. That is what I told you. That is called as inverted duty structure refund.
Okay, sir. Sir, reverse charge application on CA invoice. Can we claim reverse charge applicable?
There is no reverse charge on CA invoice. CA services, as I have listed all the services, you would have seen, CA service is not coming under reverse charge. So there is no need to pay reverse charge on CA services.
Okay, sir. Sir, for obtaining certificate of priority sector loan, is the bank liable to pay which the bank gets certificate?
Absolutely. The bank has to purchase the loan portfolio. If they have to purchase the loan portfolio, they have to shell out that money. Yes.
Okay, sir. So that's all, sir, for the question session.
Excellent.
Thanks for being with us, sir. That was a knowledgeable session. We got a clear outline of the input tax credit and entire exemptions which can be availed on that. And thanks for being with us, sir. On behalf of School of Commerce and Dr. N. Jagadishwaran, sir, and all the participants watching on YouTube, I wholeheartedly thank you for being with us for today's session, sir. Thank you so much. And I wish for more upcoming sessions with you. We gained a lot of knowledge, sir. Thanks a lot.
Thank you.
Sir, there is one more question, sir.
Yeah.
Sir, can ITC be claimed every month if returns are filed on monthly basis?
Yes. If you are filing it on a monthly basis, you can claim it every month, meaning you are showing it in the return. If you are missing that invoice in that month, then you can claim it in the next month also. There is no problem. The overall time limit is the September of the following financial year. Remember that.
Okay, sir. Sir, we can claim credit, but which year? 1920 or 2021?
Okay. When it comes to claiming ITC, you should be more focused on which return you are claiming. You are claiming it in GST return. So for GST return, it is a monthly return. So you are claiming it in which month? Before September of the following financial year, any month you can claim. Don't worry about the financial year. It will come in 2021 also. 1920 invoice, credit can be claimed in 2021 also. There is no issue.
Okay, sir. Okay, sir. Thank you, sir. Thanks for being with us.
Thank you.
Thanks a lot, sir. Dear participants, kind attention, please. The assessment test link will be sent by 8 p.m. today. So stay tuned. And I wish all the best for all of you to score 20 on 20. Thanks a lot. We'll be ending the sessions today. We'll catch up for tomorrow. Thank you.